24 seconds away from the opening bell in New York this morning. Good morning. Wrapping up Q1 and the month of March. Q1 messy, but the month of March has been a big month of gains for the S&P 500, up more than 5% coming into the final trading day of the quarter and the month. Futures down about 1/10% on the S&P. Let's see opening bell, switch on the board and get to the bond market. What a move we've seen across the Treasury curve. On 10s right now, yields lower by a couple of basis points. On the session, your 10-year 233. On the month, your 2-year up by more than 80 basis points in a single month. And here we are with an equity market doing okay. We are about 10 seconds into this session and your S&P 500 is lower by 1/10%. Energy underperforms, down 0.4% off the back of the move low we're seeing in crude. Let's get you some movers. Here's Abby.
John, let's stick with that energy story because the energy movers really do stand out on the back of that move lower in crude that you were just talking about. ExxonMobil, big oil, down sharply, although off of its lows right now, down about almost 1%. Occidental Petroleum, though, down a little bit more, down 1.5%, with yields in that big surprising move that you're talking about. Morgan Stanley, some of the banks a little bit softer, not in a big way, down about 0.6%. And yields down usually is good for tech, and we do have some tech names higher, but AMD, as you were talking about earlier, a downgrade. Micron seems to be down in sympathy with that to some degree. Plus, yesterday that stock was up on strong earnings. So across the board, a little bit of weakness here on the open, John.
Abby, thank you. It's a confusing time for energy. So this is what we know so far. A little bit later, we'll hear from the President of the United States on energy and what he's going to do about gas prices. This is what the team here at Bloomberg learned down in Washington, D.C., that they're considering the potential of a massive reserve release. Could be 1 million a day, anything up to 180 million barrels overall. Look out for that. Could be announced as soon as today. In Europe, there's this strange spat emerging between the Russians and the Europeans over gas supply and what currency to secure that gas supply in. Vladimir Putin has said this morning. Buyers of Russian gas should open accounts in Russian banks. New rules for gas payments will be valid from April 1st. Russia pledging to continue to supply gas at set volumes and prices, but ultimately they want those volumes to be paid for in rubles. And not in euros, not in dollars, but in rubles. How can that take place in the current sanctions regime, and will the Europeans go along? And seemingly at the moment, every single European leader has pushed back against this suggestion so far. I'm going to head to Europe a little bit later in about 15 minutes' time and catch up with a colleague of ours to run through the details here. Germany on the wires as well, saying the following. They say gas supplies are stable for now. They will introduce major solar and wind projects soon. The latest sanctions package is not the final one. That's the latest line from Germany. So there you are. The span continues. As for this market, the final trading day for Q1. Stocks heading for their biggest quarterly decline in 2 years. Want to get to Taylor Riggs for a little bit more. Hey, Taylor.
You know, John, I think my theme for the quarter is it is all about perspective. Now, on one hand, you could say, look, we're looking at one of the biggest quarterly drops that we've had since March of 2020 on the S&P. But look how far that we've actually come back from some of the bottoms. Remember, we peaked on January 3rd. You were down in correction territory as much as 13-14%. Off some of those recent record highs, but you had actually big rebound in March. So we are only closing down 3.5% for the year. A lot of people are actually going to call that a win, given how far we have come back from some of the lows. Really, though, John, as you know, the story is all about the bond market. Change up the board and you can see it is the biggest quarterly increase in basis points and yields on the 2-year since 1984, depending on how today shakes out. Looking at one of the biggest increases this quarter on the 10-year yield, going back in more than a decade. So really, it's all about that rate of change. And it has really been a bond story. Quickly, we'll look at, though, some of the pandemic winners and losers. A lot of the winners that we had since March 2020, those, as we think about the rotation within the S&P, some of those stocks are actually some of the big underperformers. It's Vroom, it's Fastly, and then, of course, Pinterest as well, also another one. Zoom Video off anywhere 20 to 30% as well for the quarter.
Taylor, what did you make of Restoration Hardware and that call that everybody's been talking about? What did you make of it?
You know, I think really interesting. We had a good point yesterday where they clearly have a certain customer, right, John? They are speaking to a certain audience. But if you think about a company and a CEO on that call using that macro environment to talk a lot about the supply chains, to talk about the inflation, you do wonder if it is that idiosyncratic risk or if those macro comments that he made actually do apply across the board. We're mindful there is a clear customer, though, when it comes to RH.
Taylor, thank you. If you're not familiar with this story, for our audience outside of America, a furniture store which fancies themselves as a lifestyle brand as well. You can go there and hang around a restaurant in New York City if that's what takes your fancy and you're bored on the weekend. You'd have to be very bored, in my opinion anyway. Anyway, they came out yesterday on a call and basically said that things have decelerated materially. To Taylor's point, is it RH specific or is it about something broader? Take a listen to what David Kostin of Goldman had to say on earnings.
There's going to be a significant number of negative earnings surprises. In fact, you probably get a large number of pre-announcements in the coming weeks just before the earnings season. You have these events that have really impeded a lot of sales for a lot of companies, and I think managements have been reluctant to give guidance.
Back with us, Jim Keenan, Brian Nick, Julie Bill. Jim, let's start with you. The outlook for earnings. Goldman's saying expect some negative surprises. Would you go with that?
I would, but I'd say in aggregate, I think it's going to be fairly balanced. I mean, at the end of the day, nominal growth is still going to be good. We are downgrading real growth, but with that inflationary pressures, earnings are going to be tied towards that. And I think you'll see a huge bifurcation between what industries are benefiting from that and what industries are going to get squeezed because of labor costs, input costs, or even supply disruptions. In which case, as David pointed out, they can't actually deliver the goods. So I think there's going to be a pretty bifurcated story between what you're looking at. But in aggregate, I think the earnings story over the course of the year is actually going to be pretty strong. I think margins ultimately come in a bit, but top line holds as you see a consumer in a decent space, and the labor market continues to be good. I think the consumer in aggregate holds even if it slows. And at the same time, I think business investment will continue just because of the need for resiliency, right? I mean, at the end of the day, we're looking at all these supply chain constraints. Businesses and governments are going to have to invest in more of the infrastructure on some of these secular trends. And so I think that the earnings story is pretty good. And I would say, valuations have tightened up to that story. I remain to think that that's going to be volatile. And so we still like the credit markets because of that, and certainly more on the front end where you reduce some of the interest rate vol.
Julie, from an equity perspective, do you share that more constructive view on earnings?
I think it's going to be much more of a mixed bag. I think there are definitely going to be companies that benefit or can manage through supply chains, those that have differentiated business models that can pass on pricing. But I think ones that are, just kind of your average commodity business that doesn't really have a lot of pricing power, those are really going to struggle. And, I think we all can agree that margins are pretty close to peak, and seeing margin degradation is not typically very good for valuations or earnings. We also have concerns about what's going to happen with buybacks in terms of the new regulations. So I think there's a little bit of a concern of what, earnings growth really can look like. And so for us, trying to find businesses that have earnings durability and resilience is the way to position yourself going forward.
Julie, where are you finding them? Because I think your point is an important one and will resonate with a lot of people. How can you make a forecast in this environment? Jim speaking to that, speaks to the volatility of the next year or so. You just shy away from it, saying don't even try and make one. Where are you focused?
I think where we're focused is try to find businesses that have enough of an earnings track record that you can see how they behave in an inflationary environment or even in an environment where there's a slowdown in their own industry. If you look at a company, Jack Henry, which serves financial institutions, you look at that business through the financial crisis and it looks like it didn't even happen. That's because it's so central to the operating of any kind of financial institution for which it serves. So that's the type of business that we really like.
Brian, where'd you come down on this?
I think the important story in the first quarter that you wouldn't see by looking at the data is that the economy has generally been quite good. I mean, 6 months ago or 4 months ago, we were talking about Omicron and the consumers weren't going to be able to spend them. That's not what we're seeing. The strongest part of GDP growth in the first quarter will be sales, people buying stuff and businesses buying stuff. And that should be good for revenues. So the question is going to be on the cost side. We did have in the first 2 months of the year, 1.6 million people enter or re-enter the labor force. That's going to take wage pressures off just a little bit. They're still running really high. Aggregate wage growth has been close to 10% over the last 6 months. So that could be a potential concern for profit margins. But where this comes out in terms of where to invest, I still think larger companies more oriented toward growth are going to be the preferred market here as we kind of normalize back down past the reopening phenomenon. And also as companies who probably have an ability to meet those rising wage pressures with offsetting costs elsewhere, have a little bit more room to keep profit margins wide. Small businesses are the ones that are really struggling at this point with inflation.
Brian, since everyone is reluctant to come out with a crystal ball at the moment, can we try that now? Where do you see the economy at the end of this year? I mean, I'm just looking at things play out. Consumer confidence, rock bottom, right? Gas prices, sky high. I'm seeing inflation start to bite for a lot of people. At some point, you'd have to believe that hits activity. You were talking about the top line. I'm wondering when people stop buying, when discretionary spend really gets hit around. I mean, this is what David Kostin at Goldman's getting at. He's saying that the earnings risk is around the consumer. Staples, discretionary spending, those kind of things. Do you not share that?
I'm not that alarmed by it. I think the savings rate is still 6.3% as of the end of February. I think energy is going to eat into that, but there's also a lot of accumulated savings on the sideline that isn't captured by that monthly rate. So we have about $2 trillion of extra cash on hand. It's not dispersed equally in the economy. I think the concern this year is that a lot of the growth last year came from people in that bottom 20 to 40% of income earners who spent a lot more money last year than they normally do because of the stimulus, and that money is gone. So we're not going to grow at 5.5% this year, but we can still grow at 2.5% this year on average after a shaky first quarter that I think is going to get dented by inventory decumulation. But in general, I still think we're going to be at or above trend throughout the balance of this year in terms of the real GDP growth. And we end up somewhere in the 2.5 to 3.5% range.
Judy, the eyes in the control room telling me that your head is shaking. I'm trying to work out if it's going up and down or side to side. Which one is it?
I like to be mysterious, you know. No, I think that's a really good point. I think the consumer is such a central driver to the U.S. economy, and it is starting to come under material pressure. And you're seeing that in terms of what's being bought, right? We are seeing fewer durable goods, right, because more of the budget, particularly of your lower income consumer, is just going to groceries and gas. So I think that has a material impact on the rest of the economy and earnings writ large. And, you know, if you think about what the Fed is doing, right, what's been driving so much of the economy has been, you know, purchases of homes and cars. And I think having an a rising rate environment is hopefully going to slow down demand there. But I'm not sure that you'll see a pickup in durable goods or in the rest of the economy. So I think there's downside risk in terms of the consumer's ability to continue to spend.
Home Depot already having a very ugly start to this year. Home Depot on the quarter down around about 25% so far year to date. Julie, thank you, alongside Brian Nick and Jim Keenan as well. Coming up, OPEC and its allies staying the course.
We have one objective only, which is trying to maintain the supply to the market and ensure that that supply is affordable.
I asked the gentleman, the minister from UAE, why the last meeting lasted 13 minutes. The team reporting the following this morning. OPEC Plus hurried through its last meeting in just 13 minutes without discussing the issue that was dominating global commodity markets. It beat that record by a minute at today's talks. That conversation still ahead. If you're trying to follow the gas story out of Europe at the moment, it's difficult. Breaking news in the last 15 minutes, this line from Vladimir Putin of Russia. To buy Russian gas, they need to open ruble accounts in Russian banks. It is from those accounts that gas will be paid for starting April 1st. If such payments aren't made, we will consider this a failure by the client to comply with obligations. I want to catch up with a good friend of mine and ours, Guy Johnson, out of London. Guy, make sense of this. Can you compare and reconcile the comments from Vladimir Putin with what we hear from Chancellor Scholz and Prime Minister Mario Draghi about what they said Putin told them with what Putin is saying this morning?
So I do actually think, John, that they could fit together, and here's how. Basically, you, as a gas buyer, open an account in Russia with Gazprom Bank. You then transfer foreign currency into that account. Gazprom Bank then buys rubles with that money and then buys the gas. It is unclear at this point, I admit, but that certainly fits reasonably well with what we got from Draghi. So I think this is a way of both sides kind of getting what they want, but I still think, judging from what I've read, but I think it is, as you say, unbelievably confusing, and the message is unbelievably mixed. But the text basically says foreign buyers transfer foreign currency to a special foreign currency account, and then the bank buys rubles on the exchange, which is then used to buy gas. Does that explain it? I'm not entirely sure, but that's kind of where I am.
That was better than my effort, guys, so thank you. I guess to stick to the reporting, because if I comment, I'll be deep into the realm of speculation as to what's going to happen here. From what we've heard from the Germans, are they satisfied with the supply, the volume of gas they're currently receiving?
At the moment, I think contracts are being satisfied, but whether or not that is going to be enough to deliver what we need going forward is an open question. John, at this point, when you think about gas in Europe, you need to think not about what's happening now, but what is going to happen next winter. At the moment, storage is, let's call it circa 25% full. The recent weather has been quite warm, and actually we're back into where we would roughly normally be at this stage in the year. So the tanks aren't that depleted. In fact, they're being refilled right now because the weather recently has been so warm. So we're back to we're not too far away from where we would normally be. Now the question going forward is, can Europe buy enough gas to get the tanks to where the EU would like them to be? I think it's this year's 80% full, next year it's 90% full, but that's kind of the trajectory we're on for at the moment. And in order to make that happen, European prices need to remain above Asian prices, because ultimately the swing factor here is not Russian gas, but global LNG, which is going to fill the gap.
Guy, just a final question from me. This side of the Atlantic, we'll be looking ahead to the President of the United States later. There's this conversation about a monster reserve release. How is this playing out in Europe? As most people assume that there would be a greater effort from this White House to get in touch with Riyadh. Can we just assume that that outreach has failed? And can anyone bridge the gap between Washington and Riyadh? And can that be done out of Europe?
I'm not sure it can be done out of Europe. I think that's going to be something that is going to be tricky to achieve. Look at what happened when Boris Johnson went to the Gulf, didn't come back with any extra barrels of oil, which I thought was significant. And you think about what is happening here as well with the Iran story. Basically, 1 million barrels a day is kind of where Iran would be. So you take Iran out, you put this oil in. But ultimately, John, this is probably going to widen the spread between TI and Brent. It is going to have more an effect in the United States. But long term, as somebody put it, we're going to talk to the Trafigura chief economist a little bit later on. This is a bonus rather than a pay rise, and this may discourage shale from shipping extra barrels or producing extra barrels. And the other factor as well here that you've got to bear in mind is that refineries still haven't got the barrels from the previous SPR release. So it's going to take a while for this to come through.
This has been messy for sure. Guy, looking forward to the programme. Starts in about 10 minutes' time. Thank you, buddy. Out of London, Guy Johnson there. 1:30 p.m. this afternoon. Joe Matthew from DC joins us now for more. Joe, this is going to be a big focus for you. What do we expect to hear from this president?
We're going to have this conversation in dollars, Jonathan. You're right. 1:30 p.m. We'll see how close we come to this being on time. Washington time today. as you just referred to, this is going to be a major announcement of a release of oil from our strategic petroleum reserve, but not like the single action that we've seen historically when the president makes a move like this. This is going to be a rolling release over the course of many months, 1 million barrels per month. The sources telling Bloomberg, we don't know exactly how long that will last, but could be a total release, Jonathan, of 180 million barrels. So this is a pretty big deal. The president's done this twice now, tapping the reserve. 50 million barrels back in November, followed by another 30 million in March following the invasion of Ukraine. And as we can see here in the numbers, neither went very far to impact prices. AAA has the national average at $4.24. This all comes down to what you were just talking about, Jonathan. OPEC not budging despite a lot of effort from this White House to convince them to increase production. So here we are today with an administration trying to do what it can to impact prices.
Joe, the pushback we've had, and we've had a lot on the program earlier this morning with Tom and Lisa, and again today, just skeptical minds. Why will this make a difference?
It might
Does anyone
not.
think it will?
It might not. We're talking about, there are two different conversations here. Bloomberg, we want to know what this means for prices, what it means for supplies, the global economy. Here in Washington, this is about politics. This is about perception, a White House that wants to be seen doing whatever it can to lower prices for Americans. This is going to be an inflation conversation more than an oil market conversation when the president speaks a little bit later today. Even if it doesn't work, Jonathan, they can say, walking up on the midterms, that we did what we could with the tools we had.
Hey, Joe. We'll see. The market will speak for itself, I'm sure. Joe Matthew, looking forward to the show a little bit later. Joe Matthew, sound on. Bloomberg Radio, 5 p.m. Eastern Time, Monday to Friday. And looking forward to the coverage around this from David Weston as well, going into that address by the president at 1:30 Eastern Time. Crude is lower by 4%. Brent at 108. WTI down 3% at 104. Let's get you some sector price action with Abby.
Well, John, very interesting given the fact that we have that weakness for oil itself. The energy sector is the top sector at this point, right now up about 0.6%, followed by the dividend-rich sensitive sectors, real estate and utilities doing well as rates are down. And then interesting, tech and communication services, the worst, down about 0.6%. On the year, it's all about energy, especially for the domestic producers. This is an incredible chart. The index of domestic producers on the year, John, up 52%.
Abby, thank you. Up next, your trading diary. Pushing ahead to Payrolls Friday. It's just around the corner. From New York, this is Bloomberg. have the response from Chancellor Scholz. He says the following. Breaking news. Companies must be allowed to pay for gas in euros. That's the response from Germany. Chancellor Scholz saying companies must be allowed to pay for gas in euros. Vladimir Putin, a Russian president, saying this. To buy Russian gas, they need to open ruble accounts in Russian banks. It is from those accounts that gas will be paid for starting from April 1st. If such payments are not made, we will consider this a failure by the client to comply with its obligations. How do you square this circle right now? Guy Johnson's going to do a decent effort on that in about 5 minutes' time. Look out for that. I want to run through your trading diary just briefly. You'll hear from the President at 1:30 Eastern Time. On energy prices, Friday, the main event. It's Payrolls Friday, plus Fed Speak, continuing with Chicago Fed President Charles Evans. And looking ahead to next week, oil executives heading to Capitol Hill on Wednesday. Then we'll get the Fed's latest meeting minutes. From New York City, thank you for choosing Bloomberg TV. For our audience worldwide, this was the Countdown to the Open. This is Bloomberg.
Yeah, and welcome back to Bloomberg Television. We're looking here at pictures from Van Horn, West Texas, and Blue Origin. This is Blue Origin's fourth manned mission or crewed mission, and the second time that they'll attempt to take 6 crew members. Previously, they've taken 4 up to the Kármán line, 62 miles above the Earth, the official internationally recognized boundary of space. This, is a very different kind of mission from what we see from the likes of SpaceX. They've only ever run this launch system 20 times at Blue Origin. This is NS-20 or New Shepard 20. The name of the vessel is New Shepard, as we're around 60 seconds away from launch. They use hydrogen and oxygen as the propellant rather than kerosene like SpaceX does. But there's a lot of interest here. This is Jeff Bezos' pet project, right? This is his baby that he's piled billions of dollars into annually. In the short term, this is about sending high net worth individuals, those with the money, just for a few minutes of weightlessness. They travel at 2,300 miles per hour through Earth's atmosphere into that officially recognized boundary of space. And they're up there unbuckling from their seats just for a couple of minutes to float around, do some somersaults, and then what you'll hear is a very clear warning from the mission director to get back in the seat because they're still within Earth's gravitational pull, and they will be pulled back down to Earth at astonishing force, G-forces, astonishing speed as we're around 30 seconds from launch. We're going to listen in for just a moment, but we pay attention here because it's every successful mission, a big step forward in the commercialization of space, and increasingly a ton of money, billions of dollars going into commercializing space every year. And given that we're close, let's listen in on the countdown.
5, 4, command engine start, 2, 1, 0. Ignition. And liftoff. Shepard's cruise tower.
And so far, as I see the high screen, everything, what we say, is nominal. Everything is normal. And as I said, they'll ramp up to a speed around 2,300 miles an hour. Around 20 seconds into this launch, at the 60-second mark, 60 mark, we will hit the moment of maximum dynamic pressure, or max Q. That's where there's the most stress on the rocket as it gets through the thickest part of Earth's atmosphere. And as I said, up to speeds of 2,300 miles an hour. You imagine driving fast on the freeway. This doesn't even compare. It's so fast. And then after around 2 minutes and 20 seconds, what you're seeing on your screen is a 2-part launch system. The top of that capsule has the 6 astronauts or crew members, and there was that max Q signal, moment of maximum dynamic pressure. They're reclined back in their seats, and after 2 minutes and 20 seconds, the booster, the second part of that launch system, the engines will cut off. Shortly after, at around the 3-minute mark, the capsule will separate from the booster and use its existing momentum to breach Earth's atmosphere and go beyond the Kármán line, 62 miles above the Earth, where they'll get a potentially once in a lifetime experience of floating around in space for just a few seconds. So stay watching, but Guy, Kaylee, what a lot of fun to have on a Thursday morning.
Ed, it's amazing to watch this happen and to watch it happen in a way that increasingly feels like it is second nature. They're getting pretty good at this now. In terms of where we go next, clearly they need to make sure that this is working properly, but ultimately talk about the ambition for this particular project.
Yeah, and John Ferrer asked me a similar question earlier. Is this not just routine? Well, in Blue Origin's case, it's not. You know, they just don't launch at the same cadence or frequency that SpaceX do. Jeff Bezos has piled a lot of money into this company, but this is only the fourth crewed mission, right? They've only sent humans up there 4 times, and it's only to 62 miles above the Earth. The last SpaceX mission to carry humans, Inspiration 4, went to nearer to 300 miles above the Earth, and they orbited Earth for 3 days. So you can see the gap between these two businesses. But every NASA official I speak to, every VC investor, private investor in the space industry, public markets investor, says that every one of these missions' success is important because it gets the public interested in space and it gets investors more bullish about the prospects for the industry and willing to part with their cash.
And do we know, Ed, what Blue Origin's plans are in terms of trajectory, in terms of frequency of these flights? Is this just part of what's going to be a rapidly accelerating ramp up?
Yes, so Blue Origin has a multifaceted business, much like SpaceX does. What you're seeing on your screen is tourism, essentially, right? Going into space for a few minutes, for the experience of weightlessness, but they're also a manufacturer of rocket engines, and that's so crucial right now with the conflict in Ukraine and US relations with Russia, because historically, apart from SpaceX as kind of the lead domestic player, we've relied on Russian-built rocket engines, the Soyuz engines, for names like ULA and Northrop Grumman, people like that. So with the supply of those engines from Russia cut off, the progress that Blue Origin is or is not making, as the case may be, is important because, you know, we need future access to rocket engines if we are going to ramp up space activity. And then Jeff Bezos, his vision is much bigger. Similar to Elon Musk about humans living outside of Earth's atmosphere, he's not so focused on Mars, but he basically says, if we want to prolong life on Earth, planet Earth, then we need to be mining out in space. We need to be seeking raw materials, commodities out in space, and doing more research and science based in space. So this ramp activity on launch allows a greater volume of people from all walks of life to get there.
All right, Ed Lowe, our expert on all things space, thank you so much. And of course, we'll have more from Ed later on in the show as we continue to see pictures of that 4th human spaceflight Blue Origin launch that launched from Texas. Meantime, there are other stories that we have to keep on top of. Lots in the commodity complex. Of course, just a few minutes ago, we had Vladimir Putin saying that if you want to buy Russian gas, you're going to have to do so in rubles. German Chancellor Olaf Scholz countering, saying companies must be able to purchase gas in euros. A lot of question marks on the gas front, Guy, and then on the oil front as well, as the Biden administration gets ready potentially to tap 1 million barrels per day for several months of oil from the SPR.
Absolutely. I'm not entirely sure that the German and the Russian position are contradictory at the moment. We're still waiting to get to the bottom and try and figure out exactly what is happening here, but it seems we may be progressing towards a situation where if you want to buy Russian gas, you have to open a special account, maybe with Gazprom Bank. You then transfer euros or dollars or whatever it is into that. They then go out into the market and buy rubles. Those rubles are then used to buy the gas. It seems convoluted. I'm not entirely sure what the objective is here, but certainly one possibility is allowing the Russians to support their currency. But whether or not that is too convoluted, too problematic for the Europeans, we will wait and see. But ultimately, this is gas that Europe still desperately needs.
Absolutely, and we will be trying to work our way through this confusing and complicated situation when it comes to gas over the next 2 hours. Meantime, though, we do want to focus on oil. Futures down about 4% when it comes to WTI on the news of Biden's potential SPR tapping. So that brings us to our question of the day. Is an oil reserve release the right move? Joining us now to debate is Bloomberg's Washington reporter Joe Matthew and Bloomberg's Eddie Vanderwalt from our MLive team. So Joe, let's just start with you. What exactly is the Biden administration trying to accomplish here? Is this mostly about optics?
It may well be. If you look, Kaylee, at the last couple of releases, 50 million barrels in a one-off action in November, 30 million in March. Didn't do a lot. I mean, maybe a couple days, maybe the anticipation of the release brought prices lower in the futures market. But at the pump, you can ask pretty much anybody who drives a car. Not a big deal. $4.24 right now, the national average, according to AAA. So is this going to have a big difference? It's actually a little bit unclear because we've not seen this type of approach. Instead of a single action, like I said, as we've seen in the past, it's going to be a rolling release, 1 million barrels a day for months on end until we get to about 180 million barrels. Will that have a meaningful impact? That's going to be up to the market. In terms of politics, though, and optics, to your point, this will be another narrative for President Biden to come out today and say that this White House is doing everything it can to lower prices. Of course, it cannot force OPEC to do anything, as we keep hearing. And I will add, it's interesting, Brian Deese, the president's economic advisor, is going to be a special guest at the briefing today in the White House. So they're really trying to give this narrative out to the public.
The Blue Origin booster just landing. Great pictures coming to us from that. Eddie, let's bring you in. The question is, does this have an impact? What is the market already telling us? What does the curve look like going forward? How much of an effect has this already had?
Well, I mean, it had a real impact in the immediate hours after the announcement was made, in the early hours of today in European hours. And you know what? This is a significant move. They are talking about significantly more oil than they had before, right? If they do this for 6 months or so, we're talking about 180,000 million barrels a day, right? And that will make a significant impact on the market. If we're talking about 1 million barrels a day, and we're talking about doing that for, you know, the balance in the market at the moment, the shortage is about 800,000 barrels per day. So this will shift the balance. But the problem for the Biden administration is that if they sell that oil, they have to refill at a later stage. So that means that the market says, okay, well, you're doing a lot now, but that just means we're going to have a shortage later on. Of course, the administration's hoping that by that time, they would have seen shale production and other things catch up.
Well, and what about OPEC production, Eddie? Obviously, they decided not to move forward with any meaningful production hike beyond what they were already planning to do so today. How would they view something like this coming from the Biden administration? Does it change their calculus?
Well, you know what? I think it was really significant that this announcement was made before the OPEC meeting, because it showed that there was very little hope that OPEC was going to do anything, right? It showed that the administration knew that whatever they did, OPEC was going to do what they did, what OPEC was going to do anyway. If they wanted to put pressure on OPEC, wait until after the announcement from OPEC and say, you know, run your diplomacy as hard as you can and see if you can make OPEC pump more. OPEC doesn't pump more, you say, okay, fine, we will go it alone and we will release this extra oil. But clearly, it shows that the administration has little power over OPEC.
Joe, we're watching the capsule come down. Just maybe about to hit the ground, so just stay on those pictures and watch that happen. It's, as ever, an incredible moment to see this becoming a reality. And as we talked about earlier, the progress that is being made in terms of some of these space launches, absolutely phenomenal. We are increasingly looking like we are making this look routine. Easy, maybe is a stretch, but certainly routine. I just want to bring Ed Ludlow back into the conversation for a moment. Ed, that looked flawless. That looked good. That looked like nothing went wrong. As you said, every time they do this, this is massively important. Just walk us through the significance of what's just happened.
Well, it seems strange to say on live television where we want all of the folks watching to be engaged with the screen, but every time something is successful, safe, nothing risky or worrying happens, that's progress, right? And this is the 4th time that Blue Origin has carried out a successful crewed mission. Everything went exactly to plan. It's an almost fully autonomous and automated system, right? So there's very little human intervention. And under parachute, the capsule comes at just a few miles an hour, floats down to Earth, and at the last minute, there's basically a burst of air or gas which cushions the landing. They'll give the crew inside, 6 crew members, a few minutes, 20 minutes or so to just settle down and acclimatize. And then frankly, because this is marketing for Blue Origin, right? They want to sell this product. There will be a media frenzy. Blue Origin will descend on the capsule. The media and cameras will descend on the capsule. And then hopefully all 6 members are healthy, well, they'll get out and talk about how awesome their experience was. That's it.
Well, talk to us about those members. Who made up this crew, and what do they signal about what the crews of future voyages are going to look like?
Let's be honest, the reason we were interested in this mission is because Pete Davidson from SNL, Saturday Night Live, was going to be on the crew, and he pulled out. We don't know why Pete Davidson pulled out, but his replacement, Gary Lai, was one of the first 20 employees at Blue Origin. His job title is Chief Architect. He's a senior director of the company, and frankly, he designed much of the system that you saw on your screen. He is intimately involved in the development of this launch system, so it was fitting that he went up into space. And actually, I hope to speak to him a little later today, and I'm going to ask him, you designed this system, now you've actually used it, what would you change about it? And how are you guys actually going to make money from this? Because our understanding is that Jeff Bezos and the company subsidize a lot of the passengers or crew members of these trips as their guests. So there's still a lot of question marks over the commercialization of this, what the ticket prices would be in the long term, how much you actually have to pay. But if there is anyone out there, by the way, guys, just let me ask this. If there's anyone out there that has got a ticket for a future flight or wants to go on and is talking to Blue Origin, give me a call, tweet me at Ed Ludlow, because I want to know what the process is like of booking a trip. Is it just like going on, you know, any airline website and going, oh, okay, here we go, I want to book this? Let me know what the process is like.
All right, you heard it. Ed Ludlow, find him on Twitter. Thank you so much for your great reporting. Really appreciate it, Ed Ludlow, out in San Francisco. Now coming up, we'll move from space back to what's going on here on Earth and what's going on with these markets. The first quarter is nearly over, but what opportunities await investors in Q2? Jerome Schneider, PIMCO head of short-term portfolio management, will join us for his take next. This is Bloomberg.
Questions. The jobs report last month beat estimates.
We have a very tight labor market. It is pretty clear.
Historic recovery in our labor market.
One of the best labor markets in a generation.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
More people are coming into the labor force. It's going to decelerate the wage gains. Is that good?
As the Fed looks to contain inflation, it's really important that the jobs recovery continues.
The March Jobs Report, Friday on Bloomberg Television and Radio.
honestly, I'm not sure how I'm feeling today. Is it already it's the end of the first quarter, or I can't believe it's only the end of the first quarter? It has been a very, very long 3 months, and it has been a painful one for Treasury, specifically the short end of the curve. We have seen the largest move upward in yields up, price down, going all the way back at the short end since 1984. That 2-year Treasury yield started the year around 73 basis points. We are now north of 2.2% as we close out the first quarter. So what can we look forward to in Q2? Let's ask Jerome Schneider, PIMCO's short-term portfolio management head. All right, Jerome, how much more needs to be priced into the short end? And depending on your answer to that, is there now an opportunity here?
Yeah, and I think that's the main question here. We've obviously seen yields skyrocket higher, and given the uncertainty with regard to the progress that the Fed's going to make to normalize monetary policy, that process is going to continue. But I think what we've actually seen is the market extrapolate out a good deal of that hiking cycle, of that normalization of monetary policy well in throughout this year and into next year. And so markets pricing in 8-9 hikes for 2022 and another 4-ish hikes for 2023. That's fairly well priced given where we are in the market cycle right now, given the hawkish sentiments that Jerome Powell has actually given us over the past week or two to suggest that there's a 50 basis point hike on the horizon, maybe a second one. But the real question is what is the evolution of that policy and how does it go from here? There's a couple of factors actually to embrace here and to really consider. Number one, we've had a 100 basis point hike in that 2-year note over the past month alone. So where we sit here today is we've seen a lot of price depreciation, yields higher in a very short order. That volatility should be expected as that process normalizes. But from here on out, unless there's a major recalibration of where we actually think the Fed is going to go and significantly overshoots a potential terminal rate well into the 3s, we're probably somewhat fairly priced. And the logic is this. When you think about the total return of bonds, there's two components. One, there's capital appreciation, and then there's carry and income. The capital appreciation component we've been a witness of for basically 3 decades as the tailwind of secular rates moving lower has benefited many fixed income investors. But what we're really getting to is an era of more traditional fixed income, one where carry and income actually is quite attractive. And what we will see is that higher carry and income with a 2-year note at about 2.3% is actually fairly attractive given the potential for rate hikes over the horizon, and more importantly, provides actually some cushion that carry outweighs any potential margin for moving lower in price going forward. So it's actually a pretty interesting environment for fixed income investors to find some defensive posture in that front end of the yield curve.
Jerome, where do you think the terminal rate is ultimately going to end up being, though? Brevin Howard, and they don't speak about this kind of thing very often, think rates should be between 4 and 6% now.
Yeah, at PIMCO, we think that's probably a bit high from where we're going to end up in the terminal rate. And we might overshoot a bit, but we're going to think that terminal rate is basically in the realm of 2.5 to 3% ultimately, and there might be an overshoot. So you might see an overshoot and then come back down. Part of the equation, quite honestly, has to do with the formula and introduction of the balance sheet reductions coming forth. And that's a factor that actually provides some tightening to financial conditions that, frankly, the market has pretty much overlooked. The broader market, I should say, is pretty much overlooked. So that's a factor that probably comes into consideration once that announcement is made and once the reductions to balance sheet are actually being felt, both in terms of tighter liquidity conditions, but also in terms of tighter financial conditions across risk markets.
Okay, Jerome, if I could just jump in there. On the balance sheet, I'm wondering what your assumptions about that are and how long it really does take to translate into financial conditions, considering in the 2 weeks since the Fed actually hiked rates, we've seen conditions getting easier.
Yeah, and then that's exactly the point. The Powell has basically sung a lullaby to the markets and said that risk markets are basically placid at this point in time. In fact, the financial conditions moving easier gave him the green light to suggest that they might move 50 basis points. But the suggestion is that while he has been suggesting that the balance sheet is in the background, the reality is it's probably going to become more in the spotlight as we get into the second half of 2022. Admittedly, they might start slow in terms of that balance sheet reduction and get to a point of $80 billion per month reduction, but it's going to to have a profound effect of the cost of liquidity and, more importantly, the cost of transacting business and reallocating assets from one avenue to another avenue. And so there's going to actually be a fairly rational response to this. It might not necessarily be a rapid deceleration or rapid decline in the stock market or other risk assets, but there's going to be a changing cost of capital that this balance sheet is going to be part of that equation of that normalization process. So the evolution is you're going to move from a balance sheet of about $8 trillion to $5 trillion over time, but the sizable decreases every month will eventually be felt later on this year and well into 2023. And that's effectively what the policy makers want to do, is create some more normal process along the way. And in that process, they might actually rationalize that the balance sheet does have an effect on that tightening process and procedure.
Jerome, what is the risk? How big is the tail that the Fed needs to do significantly more from here than the market is priced?
Yeah, and that is the handoff, that we need to be thinking about. Quite frankly, what we think about is the Federal Reserve and other central banks are in the inflation fighting mode. They're trying to decrease, fight inflation in the traditional and non-traditional senses. But the question is when do they pivot to the more traditional role of supporting growth? Right now, jobs are actually seemingly pretty good. We're forecasting at PIMCO 550,000 jobs for tomorrow. That's above consensus, but does that continue over time? Does labor force participation come back? What are the effects on the segments of the economy who are going to be dealing with aspects of stressflation that are impacting their daily lives? These social aspects are actually what the Fed has highlighted in the past and might actually give perhaps pause, but at least become part of the discussion points of future Fed policy. So that's a real impact that we need to be thinking about well into next year.
U.S. mortgage rates just went up to 4.67%. That's the highest since 2018. Jerome, great to catch up. Really appreciate the insight ahead of payrolls tomorrow. Jerome Schneider, PIMCO Short-Term Portfolio Management Head. Thank you, sir. This is Bloomberg.
All day yesterday.
It's time for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. Walgreens Boots Alliance posted fiscal second quarter profit that was better than expected. The credit goes to heightened demand for COVID vaccines, tests, and over-the-counter medicines. Walgreens maintained its forecast for the year. Toyota will likely be the #1 automaker in the U.S. for the second quarter in a row. That will become clearer tomorrow when most major automakers report first quarter sales numbers. Toyota offers 18 hybrid and fuel cell models, a big plus at a time of rising gas prices. And Apple is exploring new sources of the memory chips that go into its iPhones. Bloomberg has learned that potentially includes its first Chinese supplier. A production disruption at one of Apple's key Japanese partners exposed the risks to its global supply. And that's your Bloomberg Business Flash. Kaylee.
Angel, thank you. So, Guy, that's one reason Apple is in the news today, diversifying its supply chain. In many ways, I guess that makes sense. The other reason it's been in the news in the last 24 hours, it, along with Meta, subject to a hack potentially by minors in the UK and the US, posing as law enforcement officials and asking for data.
Yeah. I'm not even sure that's a hack. It's just a human error issue, isn't it?
Yeah.
Basically, this was a emergency data request, which normally you have to get some sort of a subpoena for, but this is not something that was required in this particular case, as a result of which the humans just handed this stuff over. As you and I were discussing in the break, and Alex Webb was talking about earlier, that's where the risk lies.
Yeah, in human error. A lot of systems now are fortified against these kind of attacks, the ones that are built and are machine run. But the human error portion is entirely different. And of course, this comes at a time when officials really across the world, the Biden administration here in the U.S., urging companies to lock their digital doors, quote unquote, to be resistant against cyber attacks, because that also is front and center when we think about Russia too.
Absolutely. We all take these courses, the phishing courses, all these kinds of courses that are mandatory, and that's why. Basically, it's too easy to open the door. And as you say, given what is happening in Russia and Ukraine right now, that risk is significantly rising. Kaylee, we're going to talk about the oil market next. Front and center today, energy, energy, energy. This is Bloomberg.
We're an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves for us. And Abigail, it feels like one of those days where pretty much everything is being driven by the commodities.
Yeah, I would agree with you on that, Kaylee. And it comes in the context of this mini rally that we've had for the S&P 500 more recently. It's pretty impressive that after that Fed meeting, the S&P 500 up 9.9%, really erasing most of the gains this year. Of course, on the year, the S&P 500 down a little bit more than 3%. But given the fact that at one point it had been down more than 10%, quite a recovery because of this. But on the day, it is a different story. And if we take a look at what's happening for the tech indexes, we are going to see that similar to the S&P 500 on the day, lower. Not a huge decline, but the NASDAQ 100 down about 0.4%. China Tech down more, down 4.8%. What makes this interesting is we have yields down once again, but not giving tech or stocks a relief. And oil, commodities, also not giving stocks a relief. So it's interesting that typically this dynamic, if you had oil down and yields down, that would help out the stock market. Not today on the last day of the month and the last day of the quarter. Now, speaking of oil, this is a really fascinating chart that I was taking a look at yesterday in Options Insight. I'm not exactly sure what it means. And I know, Guy, based on what John Farrow has said, you love conversations around the market. So what we're looking at here is in orange, oil, and white, we're looking at the bond volatility index. You can see that bond volatility really following the oil price. The reason I say bond volatility following oil, of course, really driven by what's been going on between Russia and Ukraine. I'm not exactly sure what to make of it, although as oil goes higher, it seems as though maybe money coming out of bonds to go into oil. I don't know, Guy, but I wanted to give this to you and Kaylee as a talking point.
So in some ways it's logical, isn't it? Oil equals inflation equals an issue for the bond market.
Yeah, works for me, Guy.
Yeah. Abigail? Thank you very much indeed. Very nice chart. Really appreciate it. Not entirely sure what Farrow means, but we'll park that one for a minute. Let's get back to our question of the day. Is an oil release the right move? We now ask that question to Saad Rahim, Trafigura's chief economist. Saad, I have to compliment you. This is the best note I've read all day on this subject by a country mile. There are a bunch of highlighted areas here. I'm going to read one of them. In short, this is the wrong supply in the wrong place at the wrong time. Not saying this won't have an impact, as it clearly is a very large volume of crude into the market, but Saad, just explain why this is the wrong move.
Well, it's really understandable what the administration is trying to do, given where gasoline prices are, given the sort of the uncertainty in the market. But